Wall Street's $100 billion bet that your house will burn down. The renewal email looked harmless. Then the number hit. A premium jump big enough to blow a hole in a family's budget. No claims, no changes, just more than double. While they scrambled, Wall Street cheered a different number. Over $100 billion wagered on disasters through catastrophe bonds. 3 years of premium spikes. Record cat losses. Insurers retreating from whole zip codes. Quick question, who profits when your street floods? What's driving it lands upstream, where your risk turned into someone else's yield? Stay with this, because we'll expose the money flow, the incentives nobody talks about, and a defensive playbook to protect your wallet, starting with the bill that broke theirs. The bill that broke the budget. They'd done everything right. The Gutierrez family bought a modest 3-bedroom on a quiet cul-de-sac. They replaced the roof after a windstorm, trimmed trees, installed smoke detectors, updated the electrical panel. For 5 years, their homeowners insurance was a routine line item, until the renewal. The annual premium jumped from $1,900 to $3,420. No claim, no renovation, no change they could see. The mortgage was steady, taxes manageable. This single number turned a balanced spreadsheet into a scramble. They called their agent. The agent sighed. He'd had this conversation all week and sent 3 alternatives. Each was worse: higher premium, higher deductible, or narrower coverage. Pick your poison. The first answer was storms. The second answer mattered more: reinsurance. That's the hidden line item you never see. Insurance for insurers, so a bad week doesn't become a bad year. When that protection gets pricier or thinner, your premium moves fast. What changed wasn't just weather. The math got harder. Losses hit more often and cost more to fix: materials, labor, code upgrades. Interest rates rose, lifting the baseline return capital could earn elsewhere. Reinsurers pushed retentions higher, which means the local company covering the Gutierrez home now eats more of the first layer of losses before reinsurance kicks in. To stay solvent, they raised rates, trimmed terms, and moved deductibles from a flat number to a percentage of the dwelling limit. A cracked window from a wind gust? On them. Microstory. 2 streets over, a neighbor got a different letter, non-renewal. Their carrier exited the state. They landed in the last resort plan with bare-bones coverage and a price that hurt. The Gutierrez family wasn't canceled. They were squeezed. Here's the affordability trap. Households set budgets around stable payments. Insurance doesn't behave. It reprices with global risk and capital. A wildfire 100 miles away, a hurricane 2 states over, a hail cluster in a different time zone. Losses roll up to the same reinsurance markets. When those markets reprice, your policy follows. They shopped. One quote came from a surplus lines carrier: non-admitted, fast to price, faster to walk away. Higher premium, but available. Another came from a regional mutual with limited capacity and a wait list. A third offered a lower sticker price but excluded wind-driven rain and capped additional living expenses if the house became uninhabitable. Every option felt like paying more for less. They debated raising the deductible. The math looked neat on paper. A $5,000 wind and hail deductible shaved a few $100s. But that assumed a clean season. One hailstorm and savings vanish. The emergency fund could cover a high deductible once, maybe twice, but not alongside rising car insurance, higher utilities, and their oldest heading to college. Then the servicer's letter arrived. Escrow analysis complete, monthly payment up to reflect the new premium. It wasn't just a bill, it was a payment shock. They hadn't decided to take more risk. The system decided for them. Curiosity loop. Why now? To understand this bruise, follow their dollar upstream. Their premium funds claims in an average year, keeps the lights on at the insurer, and crucially, buys the reinsurance that keeps the company alive in a catastrophe. That reinsurance cost reset in weeks. Regulators and households caught up in months. The decision points weren't made on their street. They were made in boardrooms in Bermuda and on investor calls in New York. Pattern interrupt. One January meeting can change your July mortgage. Their carrier renewed its reinsurance program. Prices rose, terms narrowed, some layers didn't fill. The carrier filed for rate increases. Regulators approved part. The rest showed up as percentage deductibles, exclusions, and tighter limits. Unknown to the Gutierrez family, that renewal also pushed the company to shrink in certain zip codes. Capacity moved like a tide. Their block felt the undertow. Microstory. A week after the shock, Luis stood at the kitchen counter with a highlighter, circling words that hadn't been there last year. Cosmetic hail excluded, wind-driven rain. Limited, matching not guaranteed. He looked up and asked the question every policyholder asks too late. What's actually covered now? Meanwhile, the weather was blue. No storm on the radar, no smoke in the air. The premiums still jumped. Blue skies, higher premiums. How? Finance math met climate math. Capital demanded a higher spread to take risk, just as loss expectations stepped up. Reinsurers raised retentions. Primary carriers passed the cost through. The Gutierrez family absorbed it on autopay. Here's the sting. Relief moves slowly. When capital costs drop, carriers rebuild surplus first, then file for modest decreases. Regulators ask for proofs. Households wait. Hikes are a shout, relief is a whisper. They could move. But where? They'd map neighborhoods by premium, not just schools. Newer roofs, closer fire response, fewer trees near eaves. The payment might drop until the next reset. That's the unsettling truth they felt before they could name it. Safety had turned into rent, and the rent floated with markets. How disasters became an asset class. To see why a quiet week still raised the Gutierrez premium, we need to go where their dollar went. After the shock seasons of the 199s, punctuated by Hurricane Andrew in 1992, insurers faced a blunt truth. 1 year could threaten entire balance sheets. Traditional reinsurance helped, but capacity was finite, priced by a small club, and quick to tighten when losses piled up. So a new idea took hold. Shift peak catastrophe risk off insurance balance sheets and into global capital markets. In 1997, the first catastrophe bonds took the field. Here's the basic machine. An insurer or reinsurer sponsors a deal and forms a special purpose vehicle, an SPV, built to hold collateral and follow strict rules. Investors wire cash. That cash sits in high-quality collateral, typically T-bills or a money market structure. In return, investors receive a floating reference rate plus a spread that reflects the chance their principal is used to pay disaster losses. If a defined catastrophe meets the contract's trigger, some or all of the principal flows to the sponsor. If not, investors collect coupons and get principal back at maturity. Triggers decide who carries uncertainty. Indemnity triggers pay based on the sponsor's actual claims. Clean for insurers, murkier for investors who fear exposure drift and claims management. Parametric triggers pay when measured conditions cross thresholds. Wind speeds at named stations, quake magnitude and location, wildfire acreage. They're fast and transparent, but they create basis risk. A sponsor might hurt while parameters miss, or get paid when claims end up light. There are middle roads too. Industry loss triggers tied to independent market-wide estimates, and modeled loss triggers that run the sponsor's exposure through a vendor model after an event. Who buys this risk? Hedge funds, specialist ILS managers, some pensions and endowments, and a few family offices. They chase income that doesn't swing with stocks and bonds, a yield premium for shouldering tail events, and the idea that Florida wind won't correlate with tech earnings. In calm years, coupons look fat. In bad years, principal bleeds. For a while, this stayed niche. Two forces scaled it. First, losses marched up, more property in harm's way, higher rebuild costs, secondary perils like hail and wildfire showing up more often. Second, the cost of capital moved. When interest rates were low, even modest spreads drew buyers. When rates rose, the base coupon lifted and the disaster premium widened on top. Reinsurers, bruised by clusters of events, tightened terms and pushed retentions up. Sponsors turned to cat bonds and collateralized reinsurance to fill gaps. Curiosity loop. If capital is deeper, why aren't premiums calmer? Because this market breathes. After heavy losses, funds gate redemptions, allocators hesitate, and capacity thins. Spreads widen to lure money back. Issuance climbs because traditional reinsurance is tight. A couple of mild seasons later, performance soothes nerves, capital floods in, and spreads compress. Relief trickles, hikes roar. The reset happens in weeks at the top. Households hear it months later through filings. The menu widened beyond hurricanes. Today there are bonds across U.S. hurricane and earthquake, European windstorm, Japanese quake, Australian cyclone, wildfire, and severe convective storm. Some deals are sovereign, parametric covers that wire funds to a treasury days after a quake or cyclone. Around public cat bonds sits a wider shadow market. collateralized reinsurance between one investor and one sponsor, sidecars sharing reinsurer books, and industry loss warranties that pay when the whole market crosses thresholds. It's an ecosystem, not a single product. Pattern interrupt. Follow one Gutierrez dollar. Their premium funded expected claims and overhead, but it also bought the sponsor's coupon obligations upstream. The SPV's T-bills earned a base rate. The spread on top paid investors for standing in front of the worst day. If the season stayed calm, those investors pocketed income the family helped fund. If a storm hit the trigger, the principal bridged claims, so the sponsor didn't blow a hole in surplus. Now the incentives. Banks and brokers earn fees to structure and place deals. Model vendors license engines to both sides. Managers charge management and performance fees to investors. None of them control the weather, but all of them get paid to keep the risk machine running. After a bad season, yields rise to attract fresh capital. That's not arson, it's repricing pain. Still, it lands personal when your roof budget funds a coupon that just got richer because last year hurt. Liquidity is the stress fracture. In active seasons, secondary cat bond prices gap lower as investors avoid fresh exposure. Funds protect remaining collateral and slow exits. Sponsors arriving at renewal face thinner demand and wider spreads. Terms harden, hours clauses tighten, sublimits appear, attachment points rise. Primary carriers mirror those limits in retail policies. Microstory, 3 months after a quiet renewal, a hail cluster shifts the narrative. By mid-year, percentage deductibles spread across counties like a new dialect. What nobody outside roadshows sees is how sensitive pricing is to models. Small tweaks, roof vulnerability curves, ember transport, hailstone-sized distributions, barely nudge average loss but yank the tail that sets spreads and attachments. Capital prices the tail. When uncertainty widens, investors load for it. Sponsors either pay more or carry more first-dollar pain. Households meet that pain as exclusions and deductibles. The promise was rational: tap global capital, diversify beyond the reinsurance club, reduce insolvency risk after a mega event. In practice, it moved volatility from carrier equity to consumer cash flow. The Gutierrez family didn't vote on triggers, hours clauses, or modeled tails. They met the market through an escrow letter. Meanwhile, investors miles away opened statements showing a double-digit coupon labeled uncorrelated yield. Bridge to what comes next. When the cost of that yield reset in 2023 and 2024, retentions rose, attachments held high, and spreads stayed firm. Insurers paid up or shrank. Consumers paid first. To see how that incentive loop turns personal, and why relief whispers, we need to watch how repricing travels from a wind map to a kitchen table. The incentive problem: profit when you lose. Curiosity loop: why do yields jump right after neighborhoods get hammered? Because the market pays more for pain. When losses drain funds and scare allocators, capacity shrinks. To lure money back, spreads widen. Insurers accept higher prices because they have to keep writing. The bill lands on kitchen tables like the Gutierrez's, fast. Stakes first. What's at risk isn't just insurer solvency. It's whether families can afford to stay housed. When reinsurance and cat bond costs spike, primary carriers raise deductibles, add exclusions, and refile rates. A policy that worked last year quietly stops working at the edges that matter: wind-driven rain, cosmetic hail, smoke. Meanwhile, investors who return after a hard season earn richer coupons funded by premiums like the Gutierrez's Escrow. Action. After 2023's reset, banks sprinted through roadshows pitching post-loss vintages. Managers told pensions and multi-strats. Expected losses are similar, but multiples are up, attachments are higher, terms are tighter. Clean story, better pay. Orders came in, cautiously at first, then stronger. Issuers split tranches, feeding demand at different risk layers. Coupons printed with double-digit spreads over T-bills. That money didn't arrive as charity. It arrived with covenants, hours clauses, and sublimits that sponsors mirrored downstream. Impact. Investors rebuilt funds. Sponsors rebuilt towers. The household got the invoice. Relief would come, eventually, when performance stacked, but not before carriers rebuilt surplus and regulators believed the softening was durable. Hikes were a shout, relief was a whisper. Here's the perverse edge. Disaster destroys investor principal today and raises expected returns tomorrow. No one roots for fire. but the system pays more right after it burns. If you're a long-term allocator, that's attractive. If you're gutting drywall, it feels like paying rent to risk. Pattern interrupt. Profit shows up where pain was. 2 streets over from the Gutierrez place, a hail burst turned roofs into tarps. Their carrier's top layer didn't trigger, a lower layer paid. The next renewal, the top layer's spread still widened, market-wide repricing, and the carrier took a higher retention. The household saw a percentage deductible creep higher with a new cap on matching shingles. Investors saw a thicker coupon. Same storm, 2 ledgers. Basis risk shifts quietly from capital to customers. Indemnity bonds protect sponsors. But ask investors to trust loss development. Parametric bonds pay cleanly on wind speeds or quake magnitude, but can miss the sponsor's actual claims. Either way, the sponsor's fix shows up in retail policy language. Families don't get a rebate when a parametric pays well. They just avoid a failure. They do pay when the hedge misses, and the carrier buys more next year. Opacity lubricates the loop. The Gutierrez family can't see the carrier's layers, attachments, or hours clauses. They can't see how much of their premium funds coupons versus expected claims. Regulators see some. Investors see other parts. No one sees all of it in public. That opacity makes every "we had to raise rates" both plausible and untestable. Action. Inside a January renewal, a broker warns a mid-sized carrier. Spreads are up. Top layers won't fill at last year's price. Attachments must hold. Wildfire sublimits are non-negotiable. The carrier trims peril aggregates, non-renews fringe zips, and lifts wind deductibles to keep writing. A month later, an ILS manager tells their investors, reduced frequency exposure, tighter wordings, higher multiple of expected loss. This is the moment to add. Both are true. The truth collides in households. Impact. The community sees fewer admitted options, more surplus lines, and last resort pools swelling. Citizens in wind states, fair plans in fire states, temporary scaffolding that becomes semi-permanent. Those pools assess the whole market after big losses. Even people with private coverage get surcharged on auto or surplus lines to refill them. That's the public version of the hidden tax, a levy triggered by capital's price. Memory adds fuel. 2 calmer years and spreads compress. Managers tout diversification. Sponsors regain leverage. Prices ease, but slowly, because carriers rebuild capital and regulators ask for data. Then a cluster of secondary perils resets expectations. Pattern interrupt. Calm isn't cheap, it's setup. Microstory. On a Sunday morning, Maria Gutierrez stacks envelopes, mortgage, escrow update, a college deposit slip. She opens the renewal packet, flips to the 1-page summary her broker promised, and sees 2 words she didn't last year. Percentage deductible. She checks the savings account and thinks about the roof. It's not just a policy anymore. It's a gamble she didn't choose. Complications compound through models. A small tweak to hailstone-sized distribution lifts tail losses. Investors demand a higher multiple. Reinsurers hold attachments high. Primary carriers accept higher retentions and move percentage deductibles into more zips. The numbers live in a model release note. The consequences live in budgets. Impact. The incentive chain keeps moving. Banks earn fees, managers collect carry, model vendors sell updates, sponsors secure capital, and households settle the tab. None of that is villainy. It's design. And unless incentives are rewired, passing savings down as fast as pain moves up, every reset will turn disaster into yield, then yield into rent. Curiosity loop to carry forward. Can rules, transparency, and real mitigation credits bend this loop? Or does safety keep trading like a product with surge pricing, set far from the block where the bill arrives? Reinsurance shock, the engine behind your premium. While all that was happening in capital markets, one meeting in January set the year's prices. Reinsurance renewals are where spreadsheets become bills. Think of reinsurance as the shock absorber under your insurer's car. Without it, every pothole hits capital. Programs are built in layers, from first dollar pain above the carrier's retention up to a top slice that only pays in a "we'll remember this decade" event. That tower decides whether your carrier writes your zip code or retreats. Stakes. If the tower is too expensive or too thin, carriers raise deductibles, narrow coverage, non-renew whole neighborhoods, or shrink their footprint. If it fails entirely, insolvency risk rises and last resort pools swell. For the Gutierrez family, this isn't theory. Their deductible turned into a percentage because the bottom of their carrier's tower moved upward, retention higher, attachments holding, sublimits spreading. Action. In 2023, reinsurers and ILS funds demanded more for catastrophe risk. Not just higher price, stricter terms. Attachments rose, hours clauses tightened, secondary perils like hail and wildfire drew new sublimits. Retrocession, the reinsurance of reinsurers, also repriced, lifting costs across the stack. Traditional carriers rebuilt discipline after bruising loss years, and alternative capital asked for double-digit spreads above T-bills. When money costs more, protection costs more. Unknown to policyholders, timing amplified the shock. U.S. programs renew largely at January 1st and mid-year. The one-to-one deals set the tone. The June renewals for hurricane-exposed states lock it in right as storm season opens. If spreads widen at 1/1, Florida and Gulf carriers face the music in June. Their filings hit households by late summer, which is exactly when the Gutierrez escrow letter landed. Pattern interrupt. Definitions became battlegrounds. An event isn't a headline, it's a clause. Reinsurers pushed for tighter event windows so multiple bursts of hail or clusters of thunderstorms wouldn't aggregate into one covered loss. Primary carriers mirrored that in retail policies. The same storm line moving across counties might be counted twice for you, once for them. Add exclusions borne upstream. Wind-driven rain limits, cosmetic hail carve-outs, smoke sublimits. The terms hardened at the top, the edges frayed at the bottom. Microstory. Maria printed their carrier's renewal filing summary, a public document few read. In the fine print, increased catastrophe load due to higher retention and cost of reinsurance. She circled it, then circled percentage wind deductible applies. She didn't know what an attachment point was. She knew her out-of-pocket got bigger. Impact. Carriers with strong surplus buffered some of it, but not indefinitely. Mutuals slowed hikes for members. Stock companies balanced ratings pressure against market share. Several regional writers pulled back from high-risk zips to avoid concentration. Surplus lines stepped in with availability at a price. Residual markets, fair plans, citizens grew as private capacity shrank. Those pools bought their own reinsurance at the same widened spreads, setting the stage for assessments if a season hit hard. Meanwhile, interest rates cut two ways. Yes, carriers earned more on invested float, which helped in non-cat lines. But catastrophe cost trumped investment tailwinds in wind, hail, and wildfire belts. A 5% T-bill doesn't offset a top layer that now costs multiples higher with stricter wordings. Investors compared cat risk to that 5% risk-free and price spreads wider still. The math favored caution. Complication. Model updates arrived just before renewals. A wildfire module reweighted ember transport. A hail update lifted tail severity. A convective storm adjustment recognized broader seasonal bands. Expected loss ticked up. Tail loss moved more. Brokers rebuilt towers with those new curves, and reinsurers priced to the updated tails. Primary carriers accepted higher retentions rather than pay punitive terms, then transmitted that retention change into retail with percentage deductibles and exclusions. Parallel action across town. A builders' trade group argued for code flex in a fast-growing exurb. At the same time, a reinsurer's underwriting committee flagged that county for inadequate roof attachment in older stock. The code board and the underwriting memo never met. Households paid for the mismatch through higher catastrophe loadings. Pattern interrupt. Liquidity risk met weather risk. In active seasons, cat bond secondary markets gapped lower, and some ILS funds gated redemptions to avoid forced selling into storm tracks. That made capital sticky when sponsors most needed it. To clear new placements, spreads had to widen more. Renewals became a negotiation in a seller's market. Primary carriers left some layers partially unfilled or bought parametric top-ups as band-aids. Retail saw it as coverage changes. Microstory. Luis asked their agent for a simple curve, premium versus deductible. The chart showed a $7,500 wind deductible, saved $320 a year. He stared at the payback math and closed the tab. A week later, the kids' car insurance went up too. The storm reserve jar on the fridge got a label. The jar stayed empty. Impact and meaning. The reinsurance shock transmitted in weeks, absorbed by carriers in months, and lived by households for a year or more. Relief does come. Capital rebuilds, losses normalize, terms gradually loosen. But it arrives after carriers replenish surplus and regulators see stable data. Without rules that pass savings down as fast as pain moves up, every January becomes a dice roll for July. For the Gutierrez family, that means budgeting for volatility they didn't choose, in a system where safety trades like a product and the price is set far from their street. State meltdown, California, Florida, Louisiana case files. While reinsurance reset the ceiling, 3 states moved the floor under families like the Gutierrez, and each for different reasons. Start with California. Wildfire wasn't new, the speed was. After 2017 to 2018, models stopped treating town-level losses as outliers. Carriers hit a wall. Retail rates moved slowly under state rules that limited forward-looking catastrophe models, while wholesale reinsurance repriced instantly on burn acreage and rebuilding costs. Squeezed between slow approvals and fast capital, insurers shrank footprints, paused new business near the wildland-urban interface, and pushed customers toward the fair plan. That last resort covered fire but not theft, water, or liability, so families stacked a difference in conditions policy on top. Premiums climbed, limits tightened, deductibles rose. Microstory. In Santa Rosa, a nurse replaced cedar shingles with a Class A roof, cleared a 5-foot non-combustible zone, and installed ember-resistant vents. Her carrier still left the zip code. Fair Plan Plus wraparound doubled her old premium. She did everything right and still paid more. Pattern interrupt. Maps don't set price, models do. One block's roof shapes, eaves, and distance to brush can tip expected loss enough to flip underwriting appetite. A mitigation discount helps, but capital's fear premium can outweigh it. Relief requires both safer homes and pricing that notices quickly. Florida is a different storm. Hurricanes headline, but litigation and assignment of benefits practices turned roof claims into rocket fuel. Reinsurers priced not just wind speed, but court risk. Traditional carriers failed or left. Citizens swelled. June renewals hit right as hurricane season opens, so any mid-year pricing jump lands with urgency. Private carriers added roof age rules, wind exclusions, and percentage deductibles. Citizens offered availability, but came with assessments if a major storm drained reserves. Charges that can spread to every policyholder in the state, even those outside citizens. Microstory. In St. Petersburg, a retired couple replaced an aging roof to qualify for a private policy. The quote dropped until their carrier's June renewal lifted reinsurance costs. Their new premium erased the savings. When they priced Citizens, they learned a big landfall could trigger assessments on their auto policy too. The math felt like a shell game. Action and impact. Florida tightened laws to curb abuse, and some capacity crept back. But attachment points stayed high and terms stayed firm. Insurers lifted retentions, percentage deductibles persisted, matching shingle coverage narrowed. Meanwhile, inspectors with tape measures turned nail patterns into eligibility. Safety became a checklist and a surcharge. Pattern interrupt. The storm doesn't need to hit your street pays for the state's memory. After a quiet season, spreads compress slowly. After one bad landfall, they widen overnight. Households ride both without a hedge. Louisiana's crisis is clustering. Multiple landfalls in quick succession didn't give carriers time to rebuild surplus. Several went insolvent. The state's last resort plan expanded, with higher prices and stricter terms than many expected. Reinsurers, already cautious, pushed attachments up and demanded higher retentions. Primary insurers responded with steeper deductibles and tighter water damage language. Even miles inland, where wind fields still tear shingles and drive rain under flashing. Microstory. In Lake Charles, a small grocery reopened after repairs. Business interruption coverage capped out early because the endorsement that extended it had been removed last renewal to keep the premium tolerable. One more month of lost refrigeration meant debt and staff cuts. The storm ended months ago. The insurance storm lingered. Unknown to families comparing quotes, residual markets by Reinsurance 2 at the same widened spreads. When reserves deplete, assessments appear on other lines. That's the public version of the hidden tax we traced upstream. A private pullback and a public surcharge can show up on the same kitchen table. Bridge back to the Gutierrez story. Maria asked her agent whether mitigation would help. He said yes. Roof deck renailing, secondary water barrier, impact-rated openings. He added that credits might be small against the macro repricing their carrier absorbed. She heard the subtext. Do the work anyway, but don't expect the market to notice this season. Pattern interrupt. Availability beats price when lenders need proof of coverage. In all 3 states, surplus lines stepped in where admitted carriers shrank. Surplus lines move faster and can leave faster. That flexibility keeps roofs covered and budgets fragile. What nobody sees in the policy packet is how state-specific quirks travel upstream. In California, rate caps and model limits slowed retail repricing, so carriers trimmed exposure. In Florida, legal environment amplified severity, so reinsurance priced courtrooms. In Louisiana, clustering broke time, so capital demanded wider cushions. Different levers, same outcome. Households paid first. Microstory. A Sunday morning, Luis prints a 1-page renewal delta his broker finally sends. Deductible up, ALE capped, wind-driven rain limited. At the bottom, primary driver, increased cost of reinsurance. He circles it again. It's the same line from the carrier's filing, the same line from the last resort plan's assessment notice, the same line that keeps appearing after blue sky weeks. Meaning, for now, state rules can dull sharp edges, but they can't set the global price of tail risk. Until pricing notices mitigation fast, passes softening down quickly, and makes residual markets a bridge, not a home. Families in fire belts, wind belts, and storm tracks will keep paying rent to risk on blue sky days. Climate math meets finance math. Blue skies, higher premiums. How does that make sense? Start with hazard, not headlines. Hurricanes now carry their water inland, drowning counties far from surge maps. Severe convective storms stretch longer, throwing bigger hail over wider footprints. Wildfire seasons lengthen, and embers hop block to block like dice. Flood arrives off the FEMA lines when pavement and drainage choke. None of this is apocalyptic. It's incremental frequency that stacks into real money. Exposure multiplies it. More rooftops sit where grass used to be. Materials cost more. Labor costs more. Codes harden after each big burn or blow, which is good for life safety and expensive for claims. 2 storms with the same wind can produce different bills a decade apart because replacement cost climbed. The climate ledger is simple. More to hit, more to fix, more often. Finance does its own math. When interest rates rose, cash started paying 5%. Capital asked, why take catastrophe risk unless the spread is meaningfully above safe yield? Reinsurers matched that discipline. Cat bond investors did too. So required returns stepped up, and the price of moving peak risk off insurer balance sheets rose in lockstep. Insurers paid it or held more risk. Households felt both options. Now the models, the place where the ledgers meet. Every treaty and bond leans on a distribution of loss. Average years, bad years, and tails. Shift a roof vulnerability curve for a common shingle. Reweight an ember transport module for steeper slopes. Nudge hailstone size up a notch. Expected loss moves a little, the tail moves a lot. Capital prices to the tail. Attachments hold high, retentions move higher, spreads stay wide. Those decisions look small in release notes and large in escrow letters. Microstory. Maria's neighbor paid for impact-rated shingles after a spring hailstorm. The new quote dropped barely. Her broker explained that a regional model update lifted tail risk on severe convective storms. She stared at the roof, then the number, then asked why improvement didn't count more. It did. The headwind was bigger. Liquidity turns weather into whiplash. After active seasons, secondary prices in ILS slip. Funds gate redemptions to avoid selling into a storm track. New issuance must pay more to clear. Reinsurers' retro costs rise, feeding the same loop. By January, the price of protection is up. By June, hurricane programs lock it in. By July, mortgage servicers send revised escrow notices. Markets reprice in weeks. Households rebudget for a year. Here's the quiet twist insurers live with. Rising yields fatten investment income on float. That helps. But in cat belts, the cost of reinsurance and the capital you must hold still dominates the expense stack. You can earn 5% on cash and still get crushed if your top layer doubled with harder wordings. Finance tailwinds don't outrun hail, wind, and fire headwinds when models push tails higher. Correlation is supposed to be low. Hurricanes don't arrive when tech stocks sell off on earnings. That's true for hazard. Liquidity correlation still bites. If investors need cash across portfolios, they pull from anything open. ILS managers gate to protect remaining investors. Spreads must widen to attract fresh money. Sponsors pay it. Consumers inherit it. Uncorrelated hazard doesn't mean uncorrelated panic. Pattern interrupt. Time breaks in clusters. A wet spring of hail, a summer of wildfire, a fall flood. None singularly catastrophic, together draining surplus. Finance responds by elevating secondary perils into primary pricing drivers. Hail and wildfire cover stops being cheap filler and becomes expensive must-have. That shift lands far from coasts, in counties that thought hurricane talk didn't apply to them. Parallel action across town. A subdivision wins approval on the wildland edge. Built to today's code, yes, but code reflects yesterday's fire. Meanwhile, a reinsurer's new wildfire model penalizes that exact interface. The building inspector and the underwriting committee never meet. The price signal reaches buyers through their first quote, not the planning hearing. Back to the Gutierrez kitchen table. Luis asked their agent for the premium versus deductible curve. The math said a big win deductible saved little, payback measured in decades. He then asked whether mitigation would move the needle. The agent said yes on principle, roof deck renailing, secondary water barrier, impact-rated openings, but warned that macro pricing for models and capital might swamp credits this term. They did the work anyway. Hikes are a shout, relief is a whisper. After calm seasons, spreads compress and reinsurance prices ease. But carriers rebuild surplus first. Regulators want proof the softening will stick. Filing cycles lag. The Gutierrez family might see a small reduction next year, not a rewind. Meanwhile, a model update or a stray hail cluster can reclaim it. What nobody says aloud is that trust sits on this fulcrum. Capital trusts models enough to stand in front of loss if paid. Insurers trust that rules won't change mid-season. Families trust that premiums buy real promises. Break any leg and exits happen. Capital from perils, carriers from states, households from neighborhoods. Rebuilding trust requires boring transparency. Publish credits, show model assumptions in plain summary. Pass savings down as fast as pain moves up. The ledgers won't stop drifting. Climate pushes expected loss higher and fattens tails. Finance demands wider spreads when safe yield is easy. Urban growth loads exposure. Models chase reality, sometimes overshooting. Without alignment, premiums become the bridge between hotter risks and harder money. Paid monthly on blue sky days by people who never walked into the room where the price was set. Inside a cat bond deal, from storm to payout. Curiosity loop. How does a kitchen table premium become an investor's coupon and then race back as a claim check? Follow one deal the Gutierrez family never sees, but still funds. A mid-sized regional carrier stares at its reinsurance tower and sees daylight up top. Too much. The CFO calls a bank. The pitch is simple, the work isn't. Package their peak catastrophe risk into a bond investors will buy. The sponsor forms a bankruptcy remote SPV, a legal box that will hold investor cash as collateral and follow rules no one can bend midstorm. Investors wire dollars. The SPV parks them in T-bills. The carrier pays a floating base plus a negotiated spread. Investors pocket coupons as long as the worst day doesn't arrive in the defined box. The trigger is the hinge. The sponsor wants indemnity, pay when their actual claims breach a threshold, just like traditional reinsurance. Investors prefer speed and clarity, parametric wind speeds at named stations, quake magnitude and location, wildfire acreage. Middle roads exist, industry loss estimates from a third party, or modeled loss, where a calculation agent runs the sponsor's exposure through a vendor model after the event. Each choice shifts basis risk. The sponsor asks, do we risk not getting paid when we hurt, or pay more for speed and transparency? Investors ask, how do we avoid paying for soft claims creep? Roadshows start in quiet rooms. Managers grill the sponsor. Roof age distribution, nail patterns and deck attachment, policy limits, litigation environment, hours clauses, event definitions. They backcast the bond against seasons that scarred memory. 2004 to 2005 Florida, 2017 to 2018 wildfire, last year's hail clusters. A model prints expected loss, say 2.5%, and investors calibrate spread as a multiple of that. When cash yields 5%, the coupon must clear that bar with room for pain. Orders go in. If demand is strong, the spread tightens. If cautious, it widens or the deal shrinks. Tranches appear, lower layers with higher expected loss and fatter coupons, upper layers rarer, thinner. The book closes. The SPV is funded. From the sponsor's view, they've bought a top slice that behaves like reinsurance with cash already in the room. From the investor's view, they're earning double-digit income for as long as nature stays outside the lines. Now the part that decides budgets. Late August, a storm spins toward the Gulf. The sponsor's indemnity bond attaches above a defined loss. A parametric top-up monitors wind at a grid of stations. Landfall at night, the core wobbles. 15 miles left means one station hits, another misses. Meanwhile, roofs rip, transformers pop, water intrudes under flashing. Sirens, then silence. Data becomes money. For parametric, independent agencies publish wind readings. A calculation agent applies the formula. If the parameters hit, the SPV releases principal within weeks. Fast cash into a strained claims operation. For indemnity, the sponsor submits loss development reports. An independent verifier audits exposure and claims handling. Modeled loss triggers wait on updated footprints and policy data. Industry loss triggers track a third parties market-wide tally and pay when it crosses the schedule. Investors feel the wobble in their statements. Coupons stop on the slice under review. Secondary prices gap because uncertainty is expensive. Funds gate redemptions to avoid forced selling into a storm track. Managers remark positions, warn about potential write-downs, and remind allocators they sized single-event exposure, 5%, not 50. The sponsor breathes. Bond proceeds arrive alongside traditional reinsurance below. Hours clauses decide whether clusters aggregate into one event or spill into another retention. Lawyers live in definitions, adjusters live in attics. That cash bridges claims and preserves surplus. A capital raise at this moment would be brutal. The bond exists to avoid it. Microstory. While spreadsheets churn, Maria Gutierrez stands under a blue tarp after a fast-moving squall. Her claim is small. It's paid from the carrier's base claims budget, not the cat bond. But the bond's coupons were priced using a model that includes storms like the one tearing her shingles today. The line between her roof and an investor's statement isn't direct. It's proxied by models, triggers, and layers she'll never see. In the aftermath, the deal becomes a case study. A near miss widens spreads because models push tails up. A full trigger resets pricing across that peril. Banks tweak term sheets, tighter hours, firmer sublimits. Sponsors debate swapping triggers. Investors rotate, more parametric here, less indemnity there, different geographies. By January, the new price of protection is set. By June, hurricane programs lock it in. By July, the Gutierrez escrow adjusts. The loop closes, storm to pay out to reset to bill, while the family never leaves their kitchen. The hidden tax, how your premium funds Wall Street. Pattern interrupt, your escrow has a side hustle, it pays Wall Street first. Follow one Gutierrez dollar. It leaves checking, lands in escrow, then flows to their insurer as written premium. Inside the carrier, that dollar is sliced. A portion funds expected claims in a normal year. A slice pays overhead, agents, adjusters, IT call centers. Then comes the shock absorber, reinsurance, and capital markets protection. That's where their money leaves Main Street and enters a spreadsheet in Bermuda, London, or New York. Stakes. If that upstream protection gets pricier, your coverage thins or your cost jumps. This isn't optional spend for the carrier. Miss a reinsurance installment, delay a cat bond coupon, and ratings agencies start circling. Lose the rating, lose the lender's confidence. Lose the lender, lose the ability to write policies in your state. So those wires go out first. Payroll and repairs wait. The Gutierrez premium funds solvency before it funds their roof. Action. Each month, a CFO signs 2 wires. One to the reinsurance broker's settlement account. One to the catastrophe bonds SPV trustee. Paying investors the agreed spread over T-bills to stand in front of the worst day. Banks that structured the bond took their fee on day one. The ILS manager takes a management fee and maybe performance carry as coupons roll. Model vendors charge both sides to keep loss engines updated. None of it is villainy. It's a toll road between the kitchen table and the capital stack. Impact. Add the tolls and you get a hidden tax on safety. It rises quickly after bad seasons and falls slowly after good ones. When spreads widen, carriers refile rates within months. When spreads compress, Relief trickles after surplus is rebuilt and regulators see stable data. Hikes are a shout, relief is a whisper. That asymmetry is why Maria sees the increased cost of reinsurance line every year, even on blue sky days. Microstory. Luis asks their agent to translate a filing. The agent points to catastrophe load and cost of reinsurance, then shrugs. Upstream moved. We have to follow. Luis hears. You pay because capital priced fear higher. He remembers last year's hail that glanced off their block and still raised their premium. The street didn't flood, the market did. Here's the paradox most households never see. You may be on both sides. A chunk of pension money is allocated to these same bonds and collateralized reinsurance funds because they pay income uncorrelated with stocks and traditional credit. When spreads widen, your retirement statement might look better. Meanwhile, your escrow climbs. You are paying the coupon and cheering it. Pattern interrupt. Basis risk doesn't refund you. If a parametric hedge pays the carrier because a wind station hit a threshold while neighborhood claims are modest, investors lose principal, the carrier stabilizes, and your premium doesn't drop midterm. If the hedge misses, storm jogs, readings fall short, your carrier eats losses, buys more or pricier protection next year, and your premium rises anyway. Households never share in a good hedge. They always share in a bad gap. Opacity makes it feel arbitrary. You can't see your carrier's layers, attachments, or hours clauses. You don't know whether your premium funds indemnity, parametric, industry loss, or modeled loss protection above. You can't audit the model load baked into your rate. Regulators see some under confidentiality. Investors see different slices. Consumers see none. When the bill says market conditions, it's not a dodge, it's a black box. Microstory. Maria opens a one-page renewal delta her broker finally agreed to provide. Line items. Wind deductible up to 2%, matching exclusion added, smoke sublimit introduced. At the bottom, primary driver, higher cost of reinsurance and capital markets protection. She circles it, then writes who in the margin. The answer lives in trustee accounts and term sheets, not on her street. Meanwhile, small contract edits upstream become big life edits downstream. An upper layer treaty shortens the event window for convective storms. Retail policies mirror it, and one long thunderstorm line becomes 2 events for your deductible. A modeling update bumps hail tail severity. Carriers convert flat wind deductibles to percentages across 3 states. A bank widens a spread on a top layer. Catastrophe loadings tick up in filings a continent away. The mechanism is ordinary. The effect isn't. Can carriers absorb some of it? In calm years, yes, investment income cushions. Mutuals sometimes smooth shocks. But after clusters, hail, wildfire, flood, buffer capacity things, capital must be paid for tail risk. If the price is higher, the pass-through is faster than the payback. That's the hidden tax, a market price for safety layered onto mortgages and property taxes, adjusted by investors you never meet. Public pools at a second levy. When private capacity retreats, fair plans and citizens-type entities expand. They buy reinsurance at the same widened spreads. If reserves drain after a big event, assessments land on nearly everyone, home, auto, surplus lines, spreading the cost statewide. Even if you kept a private policy, you're in the line. That's the public version of the hidden tax, visible on your bill, invisible in origin. Microstory. A month after their renewal, the Gutierrez auto policy shows a small emergency assessment. Luis calls the number. The rep explains it funds the state pool after last year's storms. Different product, same story. He hangs up and says it out loud. We're paying rent to risk twice. Meaning, when a necessity becomes a traded promise, fees, spreads, and clauses take their cut before relief reaches households. If savings don't pass down as fast as pain moves up, trust thins. The fix isn't scapegoats, it's sunlight, alignment, and speed on the way down. Without that, the hidden tax keeps compounding on blue sky days. Victims of the pricing spiral. Hook. The cheapest policy is the one that fails when you need it. Households don't shop policies, they shop survival. The first cut is coverage A, trimmed toward market value instead of rebuild cost. Then comes ordinance or law, reduced or dropped, even as building departments tighten codes. Additional living expense gets capped because the number looks big on paper until hotels run full and crews are booked for months. It's a quiet gamble. Less today, pray for blue skies. Microstory. Maya and Devin in Tulsa accept a 2% wind and hail deductible to keep their premium under a number. A spring squall throws egg-sized hail. The roof's toast. Their savings evaporate at the deductible. A contractor explains code now requires thicker decking in sections. Ordnance coverage would have paid. They didn't know what it was. 20 minutes of weather, a year of recovery. Stakes. When deductibles climb, claims behavior changes. People don't file small losses to avoid surcharges or non-renewal flags. Severity improves on insurer spreadsheets. Volatility migrates to households. A nail pop leak becomes a credit card bill. One missed paycheck turns a stain into mold. Underinsurance isn't just a big catastrophe risk. It's a $1,000 drip that compounds. Pattern interrupt. Protection flips to penalty. Lenders require proof of coverage. Miss a renewal or lose a carrier, and force-placed insurance appears. It protects the bank's interest, not yours, and it's priced like a punishment. Microstory. Carlos, a small landlord in Phoenix, misses a renewal notice during a move. The servicer slaps on force-placed coverage at triple the price. Rents no longer cover pity. He binds a replacement policy, but the force-placed carrier takes weeks to cancel and refund. Late fees snowball. No storm, still drowning. Renters feel it through the wall. Many leases pass insurance costs through. A landlord's non-renewal becomes a rent hike. Microstory. Tasha in Sacramento gets a $150 increase. Same square footage. The letter cites market conditions. Translation. Her landlord's carrier left the zip code. Fair plan plus wraparound costs more. She adds a second shift. Small businesses get cut by exclusions they didn't clock. Business interruption without civil authority or utility service turns a brief evacuation into a month of red ink. Equipment policies exclude smoke unless fire breaches the building. Microstory. A neighborhood taqueria closes for 10 days due to heavy smoke. The adjuster points to language. No direct flame, no coverage. The owner learns the endorsement that would have covered it was pulled last renewal to save $400. Staff hours get cut. Pattern interrupt. The spiral feeds itself. As households raise deductibles and trim coverage, insurers see fewer small claims and more big ones. Reinsurers, wary of frequency clustering, push retentions higher to avoid stacks of medium losses. Primaries widen percentage deductibles to match. Consumers, squeezed, raise them further. It's a ladder built upside down. Credit and closing snag on insurance. In coastal counties, banks demand higher limits or restrict acceptable carriers. Deals fall out of escrow when buyers can't bind policies. Cash buyers get leverage. Insured financing loses bids. Microstory. The Gutierrez family tours a cheaper neighborhood, maps premiums, and finds a house with newer roof deck and closer fire response. The quote is better, until their carrier's June renewal ripples through and the savings fade. They haven't moved. The market moved. Community safety nets bend. Claims denials and caps push families toward disaster aid not designed to replace insurance. Local governments face town halls about debris removal and permit delays while explaining they don't control policy language. Political pressure builds for rate caps and moratoriums. Caps slow shot, exits accelerate anyway. Residual markets swell, and assessments spread through auto and surplus lines later. Same kitchen table, two bills. Parallel action across town. A builder advertises insurance-friendly roofs. It's real, impact-rated shingles, hip geometry, secondary water barriers. Buyers ask for inspection forms insurers accept. Credits help, yet macro pricing from reinsurance and ILS spreads can drown them for a season or two. The fix still matters. The payback needs a system that notices fast. Back to the Gutierrez kitchen. Maria keeps a folder. Photos of upgrades, the wind mitigation form, receipts for vents, roof deck renailing, a letter from the inspector. She asks their agent for a one-page renewal delta before they pay. It shows higher percentage deductible, a smoke sublimit, matching excluded, ALE capped at 12 months. At the bottom, primary drivers, increased reinsurance cost, higher retention. She texts Luis. We're one storm away from an expensive quiz. Meaning lands hardest here. The spiral punishes people for playing it safe, savings drained by. Deductibles, coverage narrowed where it hurts, availability prioritized over price. Without a rule that forces relief down as fast as pain goes up, and without credits that stack through the reinsurance tower, the ladder stays upside down. The families living under it pay rent to risk on blue sky days and pray the next cloud isn't a bill. The policy crossroads. 3 paths curiosity loop. Do we want cheaper premiums, safer homes, or both? And who pays? The fork is here. Policy can dull shock, channel capital, and reward real mitigation. Or it can push volatility back to households. 3 paths, each with a tab. First, modernize rate regulation without handing the keys to models. The problem isn't using forward-looking catastrophe models. It's using them in the dark. Fix the clock and add light. Let carriers file with forward-looking cat models, but require plain English public summaries of assumptions. Peril, region, key vulnerability drivers, and uncertainty load. Mandate an independent model audit. Rotate vendors every few years, so one framework doesn't hardwire blind spots. Pair this with glide paths, pre-agreed corridors where rates can move up or down a set percentage each year, tied to verified reinsurance cost indices. Pattern interrupt, down as fast as up. If capital costs fall and reinsurance prices ease for 2 consecutive renewals, carriers must pass a defined share through within the next filing. No multi-year waits for relief while surplus quietly rebuilds. Stakes. Without speed, carriers shrink. Without sunlight, households don't trust the math. Put both in the same rule. Require a 1-page renewal delta for every policy. What changed in limits, deductibles, exclusions, and why? Reinsurance load, inflation guard, claim-free discount removed. Ban midterm non-renewals except for fraud, non-payment, or verified physical risk changes. If percentage deductibles are used, cap the dollar exposure per event. Families need ceilings, not cliffs. And make credits immediate. If a certified inspector files proof of a Class A roof or ember-resistant vents, the credit applies this term, not next. Action. Build a public reinsurance price index. Regulators, with brokers, compile anonymized tower costs by peril and region, attachments, retentions, and average rates online. Publish quarterly. Tie glide paths and pass-through rules to that index, so market moved has a number. Investors can live with transparency. Households need it. Second path. Target backstops that stabilize availability without anesthetizing price. Residual markets, fair plans, citizens-type pools. Keep roofs covered, but they've become homes, not bridges. Reset them as bridges with exits. Require annual depopulation auctions that move blocks of policies back to private carriers when capital returns. Sweetened by reinsurance, vouchers the pool pre-purchases. Tier pool rates by verified mitigation, so hardened homes don't subsidize unmitigated ones. Make the pool by robust reinsurance, including a parametric top slice that pays fast on wind speeds or burn acreage, reducing the need to assess the whole state after a cluster. Publish the pool's exposure map, funding plan, and assessment triggers. Pattern interrupt. If the public is on the hook, the map should be public. Federal levers can sit high in the tower. A national catastrophe reinsurance backstop that attaches only in multi-event clusters, priced at a penalty rate, would prevent insolvency spirals without crowding out private supply. FEMA can expand pre-disaster mitigation grants tied to insurer-verified measures that unlock rate credits. For flood, finish risk-based pricing and pair it with means-tested aid, so low-income homeowners aren't priced off maps. For wildfire and severe convective storms, fund a standards consortium to normalize event definitions and loss reporting. That shrinks model uncertainty, the fear surcharge investors add. Third path, make resilience the cheapest dollar in the system and make the market notice. Right now, credits are small, opaque, or slow. Fix the plumbing. Create a statewide mitigation schedule endorsed by regulators, reinsurers, and major carriers. Pre-verify measures that actually reduce loss. For wind, deck renailing, secondary water barriers, hip roofs, impact-rated openings. For wildfire, Class A roofs, ember-resistant vents, 5-foot non-combustible zones, hardened eaves. For hail, impact-rated shingles and documented roof age. Build a digital inspection registry with standardized forms. Carriers must ingest that data in filings. Reinsurers must recognize it in treaty pricing. ILS sponsors must disclose mitigation penetration in offering materials. If a subdivision hardens, its credits should cascade. Primary rate, reinsurance loading, cat bond spread. So savings multiply. Stakes. Households need cash to harden. Offer low-interest resilience loans repaid on property tax bills so benefits stick with the house. Tie state tax credits to measures that appear. on the registry, and to communities that adopt and enforce modern codes. Condition access to pool subsidies on code enforcement and land use transparency. If a county approves sprawl into the wildland edge, require a premium band disclosure at closing. Buyers see likely insurance ranges next to taxes and HOA dues. Unknown to many buyers, insurance can swing more than interest rates. Make it visible. Action. Connect capital to resilience. Pilot resilience-linked notes, where sponsors secure lower spreads if verified mitigation rates in their book hit targets. Investors accept a small coupon step-down in exchange for lower modeled loss. Managers publish portfolio-level mitigation metrics. Pattern interrupt. Pay yield for proof, not for fear. Back to the kitchen table. Maria's folder, photos, wind mitigation form, receipts, shouldn't be a wish. In a fixed system, her credits apply this term, her carrier's treaty reflects them, and the capital market prices them in. Her renewal delta shows a lower cat load tied to the reinsurance index. Relief arrives as loud as hikes. Trade-offs won't vanish. Faster model use risks overshoot. Public pools risk moral hazard. Credits cost cash upfront. But alignment beats drift. If rules deliver speed and sunlight, if backstops are bridges, if resilience compounds through the tower, households like the Gutierrez family stop paying rent to risk for improvements they already made. That's the path worth buying. The bigger meaning, when necessities become trades. Hook, if safety is a subscription, who sets the surge pricing? Strip away triggers, towers, and term sheets, and you're left with a shift that feels personal in the Gutierrez kitchen. A promise you have to buy, disaster protection, now trades like any other financial product. Its price moves with weather trends, court rulings, interest rates, and investor appetites. The volatility that used to live on insurer balance sheets now lives in monthly budgets. Stakes first. When a necessity trades, time horizons collide. Investors think in seasons and vintages. Families live in decades. That mismatch explains why blue sky days don't mean stable bills. Capital reprices fast. Regulations and paychecks move slow. The result isn't drama. It's drift, small, relentless adjustments that compound into a payment shock. Action. You felt the drift through the Gutierrez story. A January renewal shifted a carrier's retention. A June placement held attachments high. A model update nudged tails fatter. Spreads stayed wide. Weeks later, the escrow letter arrived. None of those decisions targeted their cul-de-sac. They were byproducts of a market stitching neighborhoods to spreadsheets. Impact. 3 things follow. First, coverage quality degrades quietly. Percentage deductibles replace dollars, exclusions nibble edges, and caps turn rare events into budget events. Second, location choices change. Premiums become another filter, alongside schools and commute. Third, resilience rises in value, but only if the system notices quickly. If credits lag, homeowners harden and see little relief, which breeds cynicism. Pattern interrupt. Fairness isn't a headline, it's a ledger. Who should carry the tail when tails get fatter? Insurers and reinsurers? Their capital? Taxpayers via residual markets? Or households through deductibles and exclusions? Today's answer is spread thin, but the fastest pass-through lands on families. You don't negotiate spreads, you receive the notice. You don't vote on an assessment. It shows up on your auto bill. Microstory. Maria looks at her folder, photos of vents, receipts for deck renailing, the wind mitigation form, and asks, "Did anyone upstream see this?" The agent nods, then shrugs. It helps, but macro pricing is heavy this term. That shrug is the meaning. If safer choices don't cascade through the tower, safety feels like a donation to someone else's margin. Meanwhile, capital claims uncorrelated returns. It's mostly true for hazard. It's shakier for liquidity and fear. When markets wobble, investors pull from open doors. ILS funds gate to avoid fire sales. Spreads widen to lure replacements. That cycle is rational up top and punishing below. Hikes are a shout, relief is a whisper. Unknown to many, you might be on both sides of the same trade. A pension-holding cat bonds cheers double-digit coupons just as your escrow climbs to fund them. That isn't villainy, it's a loop. But loops need rules. If savings don't pass down as fast as pain moves up, trust thins. Insurance runs on trust. Trust that contracts will respond, that prices connect to risk, that mitigation matters quickly. Complication. The map versus model gap widens trust cracks. Building codes update after losses. Models update after clusters. Land use approvals move on a different clock entirely. Families get the blended output as a premium and a policy that may not match how their block actually burns, floods, or hails. When that mismatch shows up as a denial, the product feels rigged, even if the clause is clear. Meaning crystallizes in choices. Communities either align incentives, so hardened roofs, vents, shutters, and codes cascade into primary rates, reinsurance loadings, and capital spreads, or they accept safety as surge-priced rent. Either way, capital will keep showing up, paid enough, with rules clear. The question is whether households see speed and sunlight on the way down, not just on the way up. Pattern interrupt. Time to invert the whisper. Relief should be as loud as hikes when capital costs ease and tails look cleaner. That means pass-through rules, public reinsurance indices, and one-page renewal deltas that name causes and credits. It means residual markets as bridges with exits, not neighborhoods with waiting rooms. It means resilience scored once and reused by everyone up the stack. Back to the Gutierrez table. They can't set spreads, but they can buy time. A storm reserve, a clean policy file, documented mitigation, and a broker who will show the renewal delta before money moves. It's not heroic. It's practical. And it matters more when safety trades like a product. Final line to carry forward. When risk became a product, safety turned into rent. The work now is making that rent lower, fairer, and worth more on the day it matters. What you can do now, defensive playbook. Start at the kitchen table. Pull last year's declarations page and this year's renewal. Make a one-page renewal delta. Limits, deductibles, exclusions, additional living expense duration, ordinance or law percentage, and any new sublimits or matching exclusions. If your agent didn't provide it, ask for it. You can't steer what you can't see. Confirm coverage A is true replacement cost, not what Zillow says. Ask for the carrier's replacement cost estimator and make them include local labor, materials, code upgrades, and debris removal. If ordinance or law sits at 10%, push it to 25% or 50% in places where codes tightened. 12 months of ALE looks fine until contractors are booked out. Push for 18 to 24 months and check for sublimits hidden in endorsements. Scan the endorsements line by line. Wind-driven rain exclusions, cosmetic hail clauses, smoke and ash sublimits, and matching exclusions quietly moved upstream. If you see them, ask what mitigation can remove or soften them. Get any promise change in writing on the binder before you pay. Shop by risk fit, not logo. In admitted markets, shortlist regional mutuals and carriers with surplus and a real footprint in your zip. If you're forced into surplus lines, use a broker who places a lot of business in your peril. Wildfire specialists in the West, wind in the Gulf, hail on the plains. Require 3 quotes and a trade-off sheet. Premium, coverage A, ALE duration, ordinance or law, wind/hail deductible type and cap, and material exclusions. Run the deductible math, not the myth. Ask your agent for a premium versus deductible curve. If moving from $2,500 to $10,000 saves $200 a year, that's a 37-year payback. Skip it. If a higher deductible meaningfully lowers premium, build a separate storm reserve in a high-yield account and label it. For percentage wind or named storm deductibles, ask for a dollar cap. If the carrier won't cap it, price a parametric rider that pays your deductible after a defined wind speed or quake magnitude. Stack mitigation that underwriters and reinsurers actually credit. Wind, deck renailing to current code, secondary water barrier, hip roof geometry if you're re-roofing, impact-rated openings and shutters. Wildfire, Class A roof, ember-resistant vents, 5-foot non-combustible zone, hardened eaves and soffits, 6 inches of vertical clearance at the foundation. Hail, impact-rated shingles, upgraded underlayment, and documented roof age. Then prove it. Get the inspection form your carrier accepts, take photos, keep receipts, and submit everything. Credits require paper. Bundle where it protects availability. Some carriers keep home coverage only if you place auto or umbrella. Price the bundle net of everything and confirm underlying limits for the umbrella meet requirements so you don't get a midterm surprise. Prevent force-placed landmines. Put your servicer's insurance department email and fax in your phone. Set renewal reminders for 60 and 30 days. When you bind, send the deck page and proof of payment to the servicer, then call to confirm receipt. If you switch carriers, overlap by a few days. If force placed appears, Bind replacement coverage immediately and demand cancellation and refund in writing. Track it until the refund posts. Split policies if it's the only way to stay covered. Fire zones. Fair plan fire only plus a difference in conditions policy. Wind belts. Separate wind policy with a specialist plus an HO, 3 for the rest. 2 renewals are annoying. Uncovered peril is worse. Leverage your broker. Ask for the carrier's reinsurance story in 2 sentences. If they can't summarize their retention, and tower posture noted, require the 1-page renewal delta every term. Ask specifically about matching coverage, cosmetic hail, wind-driven rain, and smoke. If you harden, ask for midterm credits and get the amount and effective date in writing. For small businesses, audit the endorsements that decide survival. Business interruption should include civil authority and off-premises power with realistic waiting periods. Add contingent BI if a key supplier sits in a hazard zone. Confirm smoke and ash, not just direct flame, are covered. Check equipment breakdown limits if refrigeration or electrical gear is mission critical. Renters aren't spectators. Buy renter's insurance with ALE. It's cheap and buys you a hotel when your building is uninhabitable. Ask landlords about mitigation. Some carriers pass credits through via smaller increases. Make a calm year checklist. Photograph every room. Store images in the cloud, and keep receipts for mitigation work. Confirm replacement cost, ALE duration, and ordinance limits annually. Shop every 2 years, not 10. When the market softens, be first in line with clean documentation. Map premiums before you move. Quotes can swing more than mortgage rates. Price insurance on homes you're considering. Roof age, geometry, and distance to fire response change numbers fast. A newer, hardened roof can be worth more than a lower listing price. Finally, build your own passing lane. Ask your state for a public reinsurance price index and 1-page renewal deltas by rule. Support codes that harden roofs and vents. Relief should be as loud as hikes. The fastest way to hear it is to make credits real and visible, and to demand pass-through on the way down as well as up. Investor angle. Participating without predation. Curiosity loop. If your escrow funds the coupon, is there any way to stand on the other side without rooting for disaster? There is, but it requires strict rules, patience, and alignment with communities. Start with the lane. Most households won't buy individual catastrophe bonds. Access comes through insurance-linked securities funds, open-end ILS, interval funds, closed-end vehicles, or private feeders. Liquidity is seasonal and unreliable. Expect monthly or quarterly windows with gates after big events. Treat this like private credit with weather risk. If you'll need cash during hurricane season, don't park it here. Know what's inside. Some funds stick to publicly placed cat bonds. Higher up the tower, more transparent, slower to pay out. Others write collateralized reinsurance, private contracts that can attach lower and carry more frequency risk. Read mandates for peril mix, trigger types, regions, and retrocession exposure. Pattern interrupt. If a manager can't show how their book would have fared in 2004 to 2005 Florida, 2011 global quake and wind, 2017 to 2018 wildfire, and last year's convective storm clusters, you're not underwriting, you're guessing. Diversify like it matters. Spread by peril, wind, quake, wildfire, convective storm, and by region, Gulf, Atlantic, West, Japan, Europe. Blend triggers. Indemnity for sponsor alignment, parametric for speed and lower moral hazard, industry loss for broad coverage. Then diversify by vintage. Allocate over multiple seasons, so you're not all in at a post-loss peak or a calm year trough. Respect basis risk in reverse. Parametric pays on measurements, wind speeds, quake magnitude, so it can fund communities fast. It may also pay where impact is uneven. Favor managers who disclose grid design, data sources, and how parameters map to real-world damage. Indemnity aligns with actual claims, but carries uncertainty in loss development and exposure creep. Blend, don't bet. Fees eat spread. You're already being paid to bear tail risk. 2 and 20+ model costs and trading slippage can have your edge. Look for managers with modest management fees and performance fees calculated on net asset value after loss marks, not rosy estimates. Ask about incurred but not reported accruals and how quickly they mark down after events. Pattern interrupt. Slow marks protect fees, not you. Set hard limits. Cap single event exposure, so one storm can't take more than, say, 5% of fund NAV. Cap peril region weights. Require second opinion modeling on private deals. Keep collateral clean. T-bills and bankruptcy remote SPVs with clear waterfalls and no rehypothecation. Avoid leverage. You don't need it in an asset class built on tail. Liquidity correlation is real when fear climbs. Markets wobble, investors redeem, and ILS funds gate to avoid selling into storm tracks. Build cash elsewhere so you aren't a forced seller. Size this sleeve small in a household portfolio. Single digits, not the rent money. Expect principal losses in bad seasons and zero coupons while losses develop. If that thought makes you queasy, don't cross this line. Now the alignment filter. Don't root for fire, design around it. Favor managers that fund community-positive structures. Parametric covers for municipalities and utilities. Microparametric products that pay households fast to cover deductibles. Resilience-linked notes that cut spreads when verified hardening hits targets. Ask for a resilience policy. Do they pressure sponsors to track mitigation? Do they publish high-level exposure footprints? Do they support standards that make credits usable in treaties and securities? If the answer is we're just price takers, they're leaving the only lever that helps households on the table. Vintage discipline wins cycles. Write your plan before headlines hit. Add after losses widen spreads. Trim when multiples of expected loss compress unreasonably. Revisit annually, not midstorm. And remember the household on the other side. If the structure you back doesn't help claims flow faster or encourage safer roofs and vents, it's the wrong structure. Microstory. Maria asks their advisor whether their retirement holds those disaster bonds. The advisor says yes, small slice, diversified, and part of it funds parametric covers for public entities. Maria nods. She doesn't cheer coupons. She wants a roof paid quickly and safer neighborhoods to be priced fairly. That's the only version that makes sense at her table and yours. Bottom line, you can participate without predation by demanding transparency, paying for proof of resilience, shunning leverage and high fees, and sizing the risk like a season can go wrong, because one will. That one escrow line told the truth. When risk became a product, safety turned into rent, priced fast upstream, and paid slowly back home. Start now, build a storm reserve, demand a one-page renewal delta, and file proof of mitigation before you pay. Then subscribe and watch our next deep dive for the 30-day premium cut checklist and county-by-county exit risk map. We're tracking where capital moves next, so your budget isn't last to know.